Whatif.
Stock market. I don't know if it's good, bad, up, down, but it seems to be there every day. So I go and find the daily volume. I look for the highest active traded volume on a stock. So then I find out what's behind that company that's trading. Why is it going that high? Why is that day? Is it running up, or why is it that much trading activity going on? Because there's obviously something in the works or already happened. PR could have been released. There's a lot of different catalysts that could send it to allow it to be the most volume. But if you're finding it and it's active, then you're at least my step one. And then step two, I try to find out what the company does. Is it something that is actually worth it, or is it just on the way down? Is it have a lot of activity because it's being shorted at a high amount, and therefore it's just got an unusual trading activity volume, but really it's going down, so you're just going to lose money? All those things play a huge factor. And also shorts, everyone hates the bears and the shorts, but you also love them. I love them because they're the ones that send the price up. With the squeeze, they're just normal buying activity. They think it's going to go low. They're gambling. It goes up. They have to buy and send the price higher. So that part is good. So once you have the company down and you say, it's all right, excuse the language, but it's basically a dog shit diamond is what I look at it as. So dog shit diamond is a company that looks like it's going to go bankrupt or just looks not good. Penny stocks, a lot of people don't like to trade. And you see it for a vision, or you do the research, you see who they're working with, the collaborations, all the different type of information that you gather and compile. You come out with this different perspective of this company as a diamond. That's what I look at as dog shit diamonds. And they're high risk, high reward. So then step three is finding if there's a buzz. We talked about the catalysts. Those are certain dates or events or just things that could happen or are planned. Usually they're put out by the company. That's the only way it's legit and not someone just being bullish, pumping the stock, or vice versa, bearish, and fudding your stock. Once you identify the catalyst and you understand, then you play it. You go on to step 4. When I say play, it is looking at the chart. Because a lot of people can like a company and think, yeah, I'm going to buy it, invest my money, and it could just go down. The chart could be already inflated. It could already spike. They could already have their catalyst. It's just not in a good buying period, or you didn't do it properly with very simple Fibonacci support level buys. These are just some of the simple things that a lot of people I don't think do. Even myself, when you start getting emotional trading, you forget all the techniques. These are the techniques. These are just methods. Nothing I'm saying we recommend or do. Usually people have their own way, but this just seems to be my way. And so then at step 4, you look at the chart, you're finding for a bottom. You're looking hopefully to find where the bears have shorted it down to the point where people are buying. They say this is undervalued. There's no way it could go lower, and it will go lower. So that's why you have your Fibonacci support levels. So if it's at $1, then you put your buy-ins at 95. You put your buy-in at 90. You put your buy-in at 83. You find those support levels and you don't go all in right at $1, because more than I say 99% of the time it's going to go down from your initial buy. And I know they've done a study, I don't know the exact stats, but I think it's like 90% of the time that your stop loss that you would set to sell, say you bought at $1, you're going to sell at 90 so you don't lose all your money. And like you're basically scared. We're not getting into it, but you set a stop loss. Most of the time they say, and I do agree, that your stop loss will get hit. So if you just put your buy-ins at your stop loss, then you're only going to get real money and lose what-if money. And that's, I guess, make that step 5. That's a big deal. It is a hard game. I'm not telling anyone what I'm doing is going to work. And most of the time, probably 90% of the time, you guys are going to lose money. So it's probably not the best to do. But as far as investing, find undervalued stocks. And then into step 5, which is what if for real money, is sell your stock for profit. If you buy at $1, it's at $1.10. You're saying, but what if it goes to $1.20? That's what if. Take your real money, sell for $1.10, and if it goes to $1.20, it's gonna hurt. But not as bad as if it goes down from $1.10 all the way down to 90, and now you're down 10. You know what I'm saying? It's a different ball game. Taking profit is the way you win. Making very smart buys and undervalued companies that have already been wrecked by the shorts, that basically you've found a bottom. Those are probably your best check marks right there. Your chart tells you everything. You almost don't need to even know about the company, even though it is very good to know your catalyst and what's going on for the movement. But the chart is very, very telling for the most time. So try to learn to read charts, learn bullish patterns, just all the simple techniques and methods, and just the basics and foundation of trading if you're going to get into investing.
What if